Welcome to the Daily Fortune, where we talk about the latest topics about finance and investment. But before that, please don't forget to click the like button, subscribe, and hit the notification bell so you'll know when we upload a new video. Now let's get started. Cash, as they say, is king. In times of crisis, the wealthy become even wealthier. But what the world is witnessing today is unprecedented. The experts are hailing it as one of the most significant events in human history. That in the history of mankind, the greatest wealth transfers to global elites have occurred. Housing has always been important to us humans, and it will always be important for us, as it is one of our necessities. So no wonder that housing-related investment, such as construction, renovations, and repairs, accounts for 1/6 of the US and Eurozone economies and is one of the greatest components of their GDPs. Mortgages and other housing-related credits account for a large portion of bank assets in many countries. Therefore, fluctuations in house prices have an impact on the banking system's health. And when they collapse, the consequences can be felt globally, as we witnessed in 2006 to 2008. The housing market in the United States has been in overdrive for the last 18 months since the beginning of the COVID epidemic, with huge hedge funds, private equity firms, and Wall Street banks on a buying binge, buying properties by the thousands across the country. While the demand for real estate in the country used to be at an all-time high, it appears that the tide is turning. For today's video, we're going to explain the housing market speculation in the United States today. Why are homes more expensive than they have ever been? And is this a housing bubble? In this video, we'll address these issues and take a closer look at the housing market. Let's first understand real estate as an investment. For thousands of years, homes have been a great investment choice. People typically acquire homes to earn rental income, which helps to secure a return on investment and can give some diversification when compared to an all-equity portfolio. Real estate, on the other hand, has the characteristics of both a bond and equity in that it generates a coupon-like payment from monthly rent as well as exposure to the asset's long-term appreciation. Millions of people have lost their houses since the subprime mortgage crisis of 2008. It appeared that real estate prices would continue to plummet endlessly. The US government realized that if it did not intervene, the economy would collapse. In other words, the government required more consumers. After the crisis, mortgages became much more difficult to obtain for the average person, and the government resorted to Wall Street to help revive a dying market. To put their theory to the test, the government launched a trial experiment in 2012 where private investors could buy people's homes. They were trying to artificially generate demand in a market that was stagnant. And this is not the first time the government has attempted something similar. Just like how the Chinese government grants huge firms in bulk real estate projects to huge corporations to boost demand and inflate economic data. China is one of the countries where institutions have gradually taken over and become a vastly dominant force in the housing industry. But the US government's plan certainly worked in the end. Institutional buyers increased demand for real estate, and prices appear to have stopped declining and stabilized. The economy has been saved, and you could believe that the problem has been solved for good and that the community can finally rest. But of course, there's always more to the story. When it comes to Wall Street, nothing is ever as simple as it appears. Today, the United States is on the verge of one of the most significant market transitions in history. The market is tangled up due to a lack of supply, a surge in demand, and unchanged rental criteria. Hedge funds and banks are buying entire communities, not just individual houses, streets, or apartment buildings, and frequently at prices twice or even triple what the market is willing and able to pay. Over 200 investment firms from around the world are active, and institutional money has shifted the housing market in the previous 2 years. Individuals and families are now bidding and directly competing with enormous billion-dollar institutions to acquire their homes, like JP Morgan and BlackRock. So today, the median price of a home in the United States is about $400,000. This is a huge 20% increase from a year ago, according to some, and there is no evidence of this trend slowing down. A considerable number of these properties are being sold for more than their true market value, usually in cash to profit-driven institutions. Right now, the stock market is in a chaotic state. The Federal Reserve, which is America's monetary control room, is clearly the biggest contributor to this phenomenon. In January 2021, the 30-year fixed-rate mortgage rate dropped to a low of 2.7%, incentivizing retail investors to acquire properties at bargain prices. This is the lowest it's been since 1970, more than 50 years ago. And here's the catch. The government launched a new program called the Primary Dealer Credit Facility, which was reactivated after the financial crisis and allows huge hedge funds, banks, and other financial institutions to obtain extremely low-cost credit at rates as low as 0.25%. This essentially means that while individuals have access to affordable credit, they are competing directly with massive institutions with 1,000 times more capital at near zero cost. The most dramatic events in our lives almost always occur because of global macroeconomic trends. Now that global interest rates are so low, investors are looking to maximize their yield as opposed to what they can get in places like the bond market. A rental property at almost any rate will perform far way better. The price-to-rent ratio, which compares a home's market worth to what it could rent for, is now one of the most important indicators to consider when examining price points in real estate. The price-to-rent ratio in the United States peaked at 122% in the second quarter of 2021, the highest in the prior 5 years, putting landlords in the black. Despite the availability of affordable debt, most Americans believe that their ambition of owning a home will stay a dream due to fierce competition and property costs that seem to be becoming further out of reach. The number of houses purchased by institutions increased by 2.7% in the first quarter of this year compared to the same period last year. Investors are mostly interested in single-family houses, which account for the majority of acquisitions and growth. Investors purchased nearly 70% of single-family houses in the first quarter of this year, up to 4.8% from the previous year. Even the United Kingdom's largest mortgage lender, Lloyds Banking Group, has revealed plans to buy close to 50,000 homes over the next 10 years. While John Lewis, a home retailer, has declared plans to develop and rent out tens of thousands of homes. At present, it appears like everyone wants to be a landlord. The thought of selling every single property in an entire community was always a pipe dream for developers, but it has suddenly become a reality. Property developers are able to sell everything they produce in one go, frequently for far more money than they expected, thanks to a surge of demand from institutional investors with billions of euros in their purses. These brand new subdivisions of homes are sometimes sold before the first house is even finished. Lena Core, a home builder, is constructing $4 billion homes to sell straight to investment organizations like Alliance in a joint venture. While there is a real estate price recovery as a result of large-scale transactions like these, there is very little house ownership recovery. We've now reached a point where institutional investors hold up to 20% of single-family rentals in select American areas, and international funds are now joining the party eager to profit. The question is, how did this complicated relationship between investors and renters come to this point? Renters, on the other hand, haven't had it as easy as one might expect. The stress of buying residences in bulk and quickly selling them for profit is taking its toll on the quality. Apart from the obvious outbidding situation, these new corporate landlords are naturally compared to raise profits for their shareholders, which means aggressive cost-cutting and the implementation of additional renter agreement penalties. There has been no lack of lawsuits brought against businesses for a variety of issues, including dangerous living conditions, late eviction, mold issues, pest control, and unwillingness to fix major repairs, among others. Tenants have also expressed dissatisfaction with landlords who charge them for repairs after they've already moved out. Corporations have been pooling their purchase power in recent years in an attempt to sway the market in their favor. Innovation Homes was established by Blackstone and is backed by companies like BlackRock and Morgan Stanley. Starwood was created by Colony American Houses, and it subsequently joined with Innovation Homes. Vanguard supported American Homes for Rent, acquired residential properties in the United States. Both American Homes for Rent and Innovative Homes now accounts for roughly 60% of the rental market. It's safe to say that institutional landlords didn't exist before 2010, but they've been flocking single-family rentals like bees to a hive in the last 2 to 5 years, indicating that Wall Street understands that the reality of being a young professional has changed throughout the decades. Dealing with the hardships of the Great Recession, college debt, and establishing careers, millennials and Generation Zs aren't as prepared and fast to buy homes as baby boomers were. Home ownership appears to have taken a backseat in their lives. Rental income is here to stay, and it appears that a class of individuals will emerge who will live in their homes forever at the mercy of Wall Street. Only 2 to 3% of all single-family homes are owned by institutional investors today. It's evident that institutional purchasers aren't the majority of home buyers these days, but they're on their way to being a sizable minority. And their influence on the market is far more than these numbers show. These banks, who are far more smart, competent, and informed than the average, are usually interested in finding locations where mortgages are harder to come by and where rents may be increased. Right in front of us, they're already transforming the market. Is this a housing bubble? A housing bubble arises when strong demand and strange speculation forces real estate values to skyrocket to the point where they have nowhere to go but downwards. True, market pricing is violated, and when the average person with little to no money jumps on the bandwagon to make a fast profit and accumulates a cash mountain of debt, it only takes one spark to set the whole thing on fire. I will also highlight how important it is for Zillow, a billion-dollar US real estate company, to leave the iBuyer market, and how there's a good probability that they are anticipating something unusual in the real estate market. The company that prides itself on technology uses and has used algorithms to calculate the location, size, condition of the property to help them analyze market trends like no other, recently pulled out of their iBuyers program. And the mainstream narrative is that they were simply buying homes for too much money and got it all wrong. But I'm not so sure about that now. iBuyer is a company that assists people with buying and selling real estate with a click of a button by employing technology to calculate how much a home is worth. This is a digital transaction in which the two parties do not need to meet in person or visit the property. For years, this had been Zillow's major source of revenue, but because they shut it down, ensuring that money would vanish, the company was forced to lay off 25% of its workforce. Zillow has attempted to clarify that the closure is due to technological issues, but my guess is that the corporation has been anticipating a market correction for some time and wants to tie up loose ends and straighten out its affairs before things get really bad. Other competitors, such as Opendoor and OfferPad, appear to be capitalizing on the iBuyer space. Revenues for both corporations recently reached new highs. A mortgage rate hike is the only thing that will slow the rate of home price growth right now, which would be a Pyrrhic win for home buyers, according to the CEO of another competitor company called Redfin. According to the company, the median home sale price in December was up 14% from a year ago, barely behind the all-time record reached in late November. At the time, it appears that all iBuyers, except for Zillow, believe that there won't be a correction and that there is still money to be earned. But the question remains, what does Zillow see that they don't? Don't you think so too? In my opinion, it all boils down to interest rates and the reality that they will rise. So how do interest rates affect investors, homeowners, and property prices? Well, to explain this, higher interest rates means that buying a home becomes more expensive for both investors and homeowners. As debt gets more expensive, repayments rise along with the demand, and the result is always a softer housing market. We're already seeing initial signs of a market slowdown in places like Canyon County, Boise, and Idaho, where according to Bloomberg, roughly 8 out of 10 properties have lately had their prices reduced. They also said that CBH Homes, one of Idaho's most well-known construction companies, has 80% of its Canyon County homes on the market at a discount. All of this has happened in the last month, but some may say that interest rates aren't relevant. Inflation is the actual issue here, and because home values are high, they should rise with inflation, right? And although higher inflation should logically raise the value of a property, this does not always mean that an investor's wealth is secure. Housing is often regarded as a good inflation asset, in part because its value is projected to rise with inflation, but also because it's frequently a leveraged asset. Your debt is practically inflated away each year if your interest rate is lower than the rate of inflation, which can be quite advantageous. There would be a problem when interest rates are greater than inflation when real interest rates are positive, and home prices do not rise at the same rate as the rest of the economy. The housing market isn't going to be soaring forever. With 3 interest rate hikes projected for 2022 and inflation likely to remain exceptionally high, the Federal Reserve's policymakers aim for a healthy inflation rate of around 2%. However, that number is currently at 6.8%, the highest in over 30 years. While the true figure, which is not influenced by the Fed, is much above 10%, the conflict between the Federal Reserve and inflation could be the missing piece in the puzzle to explain why Zillow ended its iBuyer program. For almost 2 years, the Fed has been aggressively promoting liquidity by lowering interest rates and printing money. It's because of these policies that certain places in the United States have had such extraordinary growth rates. However, situations are changing. The money printer is being shut down, and interest rates are rising to keep inflation in check. As a result of increasing interest rates, mortgage rates will certainly rise, which will have a significant negative impact in places like Texas, Boise, and Ogden, where the market has been too hot and prices have grown to unsustainable levels. Cities like Chicago, Hartford, Las Vegas, and Bridgeport, on the other hand, are much cheaper today than they were before the 2007 housing bubble. And while the Fed's change in monetary policy will have an impact on these locations, they will likely weather the storm far better than the majority. One small hole is all it takes to burst a bubble, as we saw during the 2008 financial crisis when one man bet against the market and came out on top. Outliers are those that eat the entire pie and become fabulously rich while the rest of the market goes bankrupt. In a depressed market, the herd nearly always loses. With the new Omicron variant spreading faster, we can say that the pandemic has far from ended, but it's most likely that many institutions will benefit when the market turns. Lockdown measures were completely lifted. As liquidity is withdrawn from the market is likely to fall with it. And if it happens, the number of distressed sales will skyrocket across the country. So here's my question. Who do you think will be the first one to buy these houses at absurdly low prices? On our top list, it's the banks and hedge funds. Ordinary working citizens will suffer the weight of the crash, while Wall Street elites pick up properties for pennies on the dollar. When interest rates rise, there's a good possibility the housing market will slow down. And there's a good chance prices will fall in 2022. Will we see a big difference? Unfortunately, only time will tell, and we'll have to keep our eyes open as everything unfolds. Thank you for watching. So that's it for today. I hope you learned something from today's video, and to get updated with the next videos, don't forget to hit the notification bell. See you next time.